Good day, everybody. It's Greg Schnell, and I am here with the Canadian Technician Report for May the 2nd, 2019. It's a big week with lots going on. A Fed meeting yesterday to confuse everybody, and we got a lot to talk about today. So we're going to roll through that right away here. Email me at gregs@stockcharts.com or on Twitter at SchnellInvestor. And for the agenda, TSX fails to hold the breakout to new highs. We're going to spend a bit of time on that. And then full alert for the right side of a major market top, and I'm going to cover that off. Energy hard reverse, those are moving down fast. And marijuana names might be the next failed breakout, and there's a reason to really be cautious here on those names. And I literally went into some of them and out of them in just a few days here, just because they started to roll over after breaking out. So let's jump into it. I want to start off. Okay, so first of all, the top up here is the bullish percent index, and we have a little bit of data that kind of kicks in 2001. Stock charts started in 1999. So this is kind of the bullish percent index data we have. But more importantly, what I want to point out here is that these major market tops, and if we just back in this one here was the Nortel day, and basically we ran up and it was a pyramid and just blew off the top and came straight back down the other side. The one in 2007, 2008 was a complex top. And it's important to see what happened here. And the point I want to make is it broke through this trend line, this big trend line, came down, and then went on a final rally, almost a surreal rally, but a final rally. And so while the US market was falling, the Canadian market was soaring, and that was on the back of expensive oil, and oil got up to 149.20 or something like that, or 148.90. So really high, and then came down. But this was a relatively steep shoulder. And so the concern I have is that I think we're building this sort of a case here. So we have had the trend line break. On that trend line break back there, and this obviously looked more severe at the time. You didn't have all of this data over here. Was you made lower lows. And then we made a double bottom. And then we took off to the upside, and it looked like the all clear. Broke through prior highs and immediately failed and broke this trend line. And then on the way back down, you can see we jogged a little bit as we got down into this kind of lower end of the range, or middle of the range, and then the lower end of the range. And when we went through that, we snapped hard, and that was obviously the financial crisis. So are we in that? I don't know. But one of the things that keeps coming up to me is a lot of divergences on long-term advanced decline lines and that kind of stuff. But I did hear somebody speak today, and it was from Carter Worth's company, and I think it's Cornerstone Macro, I think is the name. But the important thing on Carter's company, and it wasn't Carter who was talking, it was somebody else from their firm. And the issue that he brought up was that the global PMIs have been dropping every month for a year in a row. And this is, so this is the first time ever since they've been recording them that they've all dropped, that they've had a drop this long in a row. And of course, China's central bank has been trying to speed things up, but it hasn't really helped yet. And so with the rest of the world not really participating in a active monetary policy increase, activity increase, perhaps we're setting up for something like that. So the main issue for me is that we're very vulnerable in terms of where we are. So the bullish percent index is at 60%, and you can see that in this big downtrend here, when this finally broke, this looks pretty good, so we broke it, so maybe we're on our way to the moon and all that kind of stuff. Get it. The big issue I have is that I'm not seeing that on the advanced decline line, and it's big picture advanced decline line, nor am I seeing that on the net new highs. And so we're going to cover those two charts off, but they've been kind of a stable a source of worry for me for a while. We just can't seem to get that breakout. And so that's what I want to talk about. But in general, to me, we look a lot like this 0708 top, where basically we go up, we made a high, then we made a lower high. In this case, we made a higher high, and now we're making another high. But we've rolled back over here. We're already back below the September peak, and now 16.4 tests the January peak. So lots of work here for the Canadian market, and really makes me want to stay focused. So here we are. This is an interesting chart, and it's nice just because the timing works more than anything. But if we look at the percentage of stocks above the 50-day moving average back in 2018 in early January, we got up, and this number over here, the line is at 50%. And the reason it was at 50% was because that's where we were for May the 1st. And the interesting part is when you fell below May the 1st, we kind of fell off here, and so did the stock market. When we look in June, July, August, September, of course, the U.S. market continued to go higher. We topped out in July, early July, up around 70%, and then this pulled back, and the market really wasn't pulling back that hard. I mean, this would be considered a normal correction if it had just turned around and started going back up. But we got down to 50%, and then the market really started to drop. And it's kind of this drop here. So we're at the 50% level, and now we're starting to go below that. So what this means is less than 50% of the stocks are above their 50-day moving average. So a 20 day is kind of a nice gentle uptrend. When you start testing your 50-day, that's important. And so that's kind of an intermediate bias. And then you have the longer term moving average, the 200-day, which is down here in red. And what we have there, that's shown in this black panel here. And so back in 2018, we kind of got stuck at this 60% level or 65% level. And then when we started to break down with that, and when the stock started to move under, that's when we got this drop. And what you don't know is the speed. Is this going to be like this, or is this going to be like this? And my concern is because it's the third top, I think that it'll be more acute, it'll be more aggressive, and I feel like oil's falling away aggressively to help support that thesis. Now, we don't need to rush into this, but we do need to be safe here. If this is going to make one of those U-turns and then not come back for a while, that would be a bigger deal. So we were lucky, or we've enjoyed the 4-month rally. Let's try and bank our profits and make sure that we don't give them away. So here we are in June, July of 2018, and we top out with roughly 65% of the stocks above their moving average and roll back over. And again, we're drifting lower here, but nothing really strong. This is the final high in the US market, the September high, and we're making lower highs already. Now, you can see in January we correlated tightly with the U.S. market breaking away, and in July, August, September we kind of were moseying already down, and then we got stuck under our 50-day moving average and fell. So very clearly, very early to call some sort of a major top, but I think the more important thing to remember, again, and back in October, I was worried that that was a major top. Well, we've gone all the way back down and all the way back up to get back there, and I said we'd want to participate in bear market rallies because they're fast and furious. But the bigger clue for us in this is this third top, and it's this continually testing of this level. Global PMI is weakening, Purchasing Managers Index is weakening, and we're really not getting strong data from around the globe. And everybody wants to ignore it and say the U.S. is doing fine. And I will say the U.S. software business is doing fine. The big tech companies that write software and then they can apply it across millions of users, that's doing great. There's a lot of other things like the trucking industries that are not giving us the same sort of data. And manufacturing globally, Jay Powell yesterday acknowledged that he sees it slowing down. So a couple of things here. One is that this trend line across the tops is coming in and basically saying, yeah, here we are. On the chart previously, it was the uptrend line that we're breaking, and we're right back to it. So, and it's not uncommon to backtest a trend line and then find that that's your breakaway point. So it looks like it's going to a higher high, it backtests, and then it fails. I'll go back and cover that in just a second. So the other way to look at this data is to make a ratio of the percentage of stocks above the 50-day to the percentage of stocks above the 200. And when you go below the 1-to-1 ratio, that's up here a little higher than this line, but the 0.95 suggests getting cautious. And I mean, I've been cautious probably since late February, mid-March. And the reason is because this rolled over quite quickly, and I felt like we might just be getting a hump in the ground. But we did run on a little bit more. And so what we've got now is that this is clearly breaking down, and you can see back in the October time frame. So again, September 31st, or the end of September, September 30th was kind of the final highs, and then rolled out of there. And the Canadian market, I think, topped around the 21st and then started to fail. But looking back over here in the January timeframe, we saw the same thing where basically it couldn't get back up into this big bullish area and fell down. And then it rallied back up and it stayed up here. And for all of this time, while we're above, we have this nice big rally. And then we get down and this ratio starts to drop. Now you can wobble in here like we did July, August, September, or you can go straight through it like a knife through butter. And we have done that. And so, whatever, we get a bounce here. But I think the bigger issue is to just be aware of how vulnerable the market is from a very large macro perspective. And we've had a relief rally. And again, the January top, the September top, and if this ends up being a top for the U.S. market, all three of those will be on Fed meetings. And this was Jay Powell's first Fed meeting, his sixth Fed meeting, and now his 11th Fed meeting or something. But just watching these Fed meetings make market tops is a pretty important concept, and I'll show you that in a second. I just want to go back and show you this sort of back test of the trend line. So what I wanted to show you is this line coming in here, and we can zoom in now in the last, 10 years or something like that, and focus on that. Oh, you know what? Why don't I go out just 13 years, and that'll include the 2007 top. And so the point I want to make here is this triple top structure there, and all going to be the same. But we definitely have a neckline in place here around 15,000, and that would be a pretty important one to hold. And again, the problem I have is all of these charts are starting to line up with the data starting to fail at exactly where it failed on this top, or sorry, on the 2018 January top, the October 2018 top, and now the same period. And if we take this next chart, this bullish percent index chart, and I haven't done this in advance, but let's just go back and look at the 2014-2015 period, and we'll just change it to select start and end, and we'll just take the slider and move back here. So let's cover this 2014 because it was roughly September, and then we topped out in March, April. So here we go, and we see that the market was, the Canadian market was rising all through this period, and from this ratio perspective it had gotten under but kept on going. That's fine. The important thing here was this big breakout here coming off the back of that was a pretty good place to get long. And then as we fell back down here in May, this was kind of when the market started to break down again. So we see this, and then what happened up here was when we started to fall below 50%, this was a meaningful place to get cautious, right? All of this time we're well up above that. And so, and the percentage of stocks above the 200-day moving average was around 65%. And as long as we were above that, we were bullish, and then we fell down. Well, in May, we didn't even get back up to 50%. We just barely clawed our way there. And every one of these market tops in here were met with the same rollover problem. So we can slide out to 2016 and just show what happened. So October 2015 was a major market top before we rolled over on another leg down. And what you see here was we rolled over. So let's go up here. We had some brief stabs up above this 50 level, and when we got to 50, we had this pullback, and then we rallied back up and we had this pullback, but we never did start to get percentage of stocks above the 200-day going. So one of the concerns I had recently was we actually got down to a very low level in December of our percentage of stocks above the 200-day, and to me that marked a more significant low starting to come. So here we are at 50%, rallying above that level on the percentage of stocks above the 200-day moving average, and stays above there, and we got one dip in here, but stays above that in general. Again, this is a daily chart, and if we push this out a long way, the point I want to make is, when you're above this 50-day, this is or 50% level, it's pretty good. And when you start to dip below it, it gets a little more rocky. So the market starts to dip down here. And in this case, the trend still continues. We have some wobbling back in here, but we still have, more than 60% of stocks above their 200-day. And when that starts to break down, then that might be more concerning, right? So it's kind of using the two of them as a tool. This is kind of a deeper basin to be aware of. And then the percentage of stocks above the 50-day kind of helps you with a little short-term rally data. And again, we don't want to trade every short-term little blip like it's a major issue. The bigger concern we have on this is that the advanced decline line data is very negative right now, as is the percentage of stocks above the 200-day moving average. So let me go show you those two charts because I think they're kind of critical. So here's the percentage of stocks, the number of stocks making new highs. And what we see here in a big bull market like 2016, we rattled really high. So fully on board, big bull, gotta like it, happy. I have been grumpy through this whole rally because we haven't been able to get the percentage of stocks above the 200-day, the percentage of stocks making new highs or the number of stocks making new highs compared to new lows has not really gotten on board. And so now we're starting to go negative again. And today was the first negative print. That doesn't make it critical. What makes it critical to me is that we're failing the breakout of the prior high. And so rather than get all enthusiastic because we made new highs, I always say as you're breaking through, you want to make sure you're checking to make sure the market's got the right data to help you make that new high. So if we look what happened in July as we made that new high, we had started to make negative net new highs just before that, and we rolled over. And so as we did that, that was telling us that the market was getting weaker again. And what we can see if we just zoom in here is that we've been making a lower number of net new highs all the way since March 1st. And so that's a concern to me that we just don't have the enthusiasm to start to get this market going. So even though the stock market's at near all-time highs, we're making less new highs than new lows. And so that's really not a recipe for a big bull market. We want to see what we saw back in 2016. And in the period of 2014, 2015, what you see is 2014, we were way up here, things were good. Then we had the September slump and we pulled back, and then we had the rally and the slump and the rally. And then as we headed up to the market top here, we got down to 0 net new highs. And that was a pretty good clue that things were starting to get dicey. And then look at this run down in 2015. Then we had this was a big rally in early 2000, in October, and literally shot right up and then rolled back over and came all the way back down. And this whole thing, I think, was roughly 20%. Let's pick a number here, 15.5 to 12,000. So we dropped 2,500 points. Yeah, pretty close to that. So maybe 15% or something. So a big drop down here, and then we get this bull market rally, and you can see within 3 or 4 months we're already making net new highs, and yet over here the stock market is nowhere close. So the problem I have is here we are, the stock market's making new highs, and we don't have any of this net new high data supporting the move. So that's a really critical point to me, is that we just don't have enough net new highs to carry this market higher. Okay, one more thing to go through and just hammer this point home, because I think it's really, really important. So what we saw in 2014, the market rallied, pulled back, and then here's the 2015 high, roughly April, May, sound common. Anyway, and we get up here in April, May, but look at how much lower on the advanced decline line we were here. And then what we saw was with this dramatically lower advanced decline line, even though the price was up at the same level, this was a concern. Well, fast forward the tape in the July high that we made in Canada. So we had higher highs, but we had lower highs coming in here on the advanced decline line. And while they were wiggling all the way through July, August, September, there was no doubt that they were lower than the prior high, even though the market went higher. And then what we saw was this rally in the most recent example took us up, but look at how much lower our advanced decline line is. And the way this line is created is you take what we call a running history or a cumulative total of how many advancers versus decliners. So let's say on a given day there's 23. Well, we'll add that to the number from yesterday and add it on or subtract it. So on the way down, we had lots of them. And then on the way back up, we didn't have as many of them. And so the issue is here we are, markets at new highs, but our advanced decline data suggests that things are weak. And we're starting to get into, this is taking a moving average because the advanced decline line data, if I turn it on, just literally soars back and forth. And I can show that to you. It's an ugly mess. So it's really hard to read this way. But if you use a moving average, it cleans up the data. And then you can take, a simple, when you're in a big bull market, you've got lots of momentum. And then as the market starts to get weak, you go below zero. Now, my concern here is that because it's the right shoulder, like if even this January one, it was a relatively sudden drop, but I think, and the enthusiasm was pretty high, and we're having all these IPOs right now, and everybody's bullish, and Pinterest went to the moon, and Beyond Beef went to the moon, and all that kind of stuff. So these stocks are, the market makes you feel bullish because it's at all-time highs, yet the odds are that you might have a stock hitting new 52-week lows as the market makes highs here. That's really uncomfortable. So you're in a losing stock and the market's making all-time highs without you. Well, what this also tells us is that less stocks are participating. So on each day, there's not as many stocks advancing compared to declining. So even if it advances $1 or a penny, that's one. And if it drops a penny or $5, that's one down. Well, the point would be here, we're not measuring the significance of the advanced decline. We're just clearly taking a simple number, were you up today or were you down today, and applying that. And this is starting to show negative. And so on the big picture, I think we're setting up the same as we were in 2015. And this was a pretty much steady march down into the September lows now, or the January lows. I don't know if we're going to end up with that. I really don't know. I just know that all of the settings are here. And now that we're starting to fail and not hold our breakout, that's a pretty important place for me to be aware of. So I'm concerned. And now if we take this chart and just spin it out, and I did this just last week, but just add data to it. What you see on the advanced decline line cumulative down here at the bottom was in 07. Here's the high in 08. The market topped out in 08, and we had a lot lower high. We do not know the speed of the decline. So that's a concern. And then in 2011 here, we made this high and then we made a lower high, but the market's not trying to make a prior high. And then we come up, so this is years later. I have trouble relating this high to this high. But nonetheless, we ran up, we roll over, and then in this 2014-15 period, we see the same sort of thing where we're testing the high, call it 6 months apart, and a lot lower participation, and down you go. So here we are right here, same sort of issue showing up, and I think we should take it seriously, mostly because it's the right side of a complex head and complex topping structure. And again, if we started to break through 15,000, I think that would be really messy. But the big issue for me is globally, we're not getting anything going. And I've talked about it multiple times. And the stock markets around the world have done the same thing. They've all rallied on the hopes that something will get better. And quite frankly, now the data is starting to run out of juice. So here's the US high-low data, and you can see it's got the same problem as the Canadian. The line's a little higher. I could move this up to, call it 150. I do find it interesting that it kind of spikes right near the end and then goes, pretty much straight down. So this is end of August, ran down here and then started to break below zero. And, the US it paused for whatever, 2 weeks down here, and then it started to go. We're still not there in the US, so the US might have a little bit more time, but the Canadian market looks to me very fragile. Okay, um, really quick, let's go into the Canadian dollar. So it's continuing its downtrend. Usually, if things were going to get better, we'd probably hope to see a ramp in the Canadian dollar like we did here in 2016. Even though oil ramped, we saw none of this, so nobody's believing it. And we've got this big momentum base setting up. And again, we had an uptrend in momentum, and hopefully we could turn and go higher from here, and that would start a new bull market for us in the Canadian dollar and maybe in commodities. We haven't had that. We've had the momentum go sideways and stay under zero, which is not a good place to be. So all of these things add up to say big difficulty. Now, the other problem we have is, so this is the year to date data, and coming off the December 31st, so not the Santa Claus low, but the December 31st, so year to date. Here's an uptrend line, and now we've broken that uptrend line. And if we, off the low, it would have probably broken in here. Probably should keep in mind that a little shallower would be better. But we now have negative divergence, and we're rolling over on this chart. We're at 0.5. That's not great. It's okay, but it's not great. So a little bit weak there. In terms of quadruple witching, we kind of hovered going into that quadruple witching, hovered for another 2 weeks coming out of it. And then we finally had, a 2 week or 3 week rally taking us up to the new highs. And now we've spent 3 weeks trying to get through that new high. And the new high, so it was around 16.6 and the previous high. And now here we are, we're back at 16.4. Now the issue with 16.4 is that it takes us to that January high of 2018, 16,421. And so we're now testing that level. And again, if we start to lose all of these tops, this would be important. So I think any sort of a break below 16.2 would kind of cement the thing. And we have this negative divergence here where we're making a lower high in momentum as we made a higher high in price. We saw that here where price ran up, and then we had a lower high in momentum. And it wasn't really until momentum got below zero that things really started to go downhill quick. Over here for the January high, we had momentum, roughly in the same level we're at, call it 0.5. And it rolled over, and then it was a pretty quick downturn. So this looks to me a lot like this. It could drag out a little while longer, but I think that the bigger issue is that we don't have the data telling us to be optimistic. If everything else was running like the U.S. side was running, that would be a lot more helpful. So we're not getting that. The US dollar is still trying to make a decision on which way it wants to go. Obviously, it pushed above 97.5, which is an interesting area. And now it's just gently trying to hold above that, closed at 97.59 today. Japanese yen is in a tight range. We're going to see which way this one wants to go. In 2015, 14, you can see the yen fell with commodities, and so I don't know what this chart wants to do. It just continues to hover in this bottom corner here, and so we'll keep watching to see which way that one wants to go. But I don't have a comforting feel that that it's going to be the clue for us that I thought it would. Both commodity currencies, so Canada and Australia, breaking lower. I think that's a big problem. So Australia's really kind of got to hold this 69, 68 level. If it starts to go, I'd say that's a major global slowdown because they do a lot of supplying to China. And here's the euro, and you can see the euro just gently grinding lower and lower and lower and losing power to the US dollar. So in 2014, we saw the euro go lower. In 2007, okay, we saw the euro kind of top out and go lower. So I'm expecting this to break lower. We'll see. But again, all of these currencies just are sitting literally at relatively risky places on their chart for breaking lower. You can see this momentum trend looks like it's about ready to crack again. And so if all of these are going to crack at the same time, I think it's a much bigger warning and not something to just kind of say, okay, it's a pullback and I'll just buy the dip. I think it's a real cautious place in the charts, and it's the monthly charts that make me think like that more than anything. So here's the TSX monthly, and the point I want to make is on momentum right down here in the bottom corner. So we have this downtrend. We're underperforming the S&P 500. We have a big major uptrend, and we broke through it in 2009. But you can see all of these other data points that we were tracking or touching. And then in 2016, we dipped below it. Then in January, we dipped below it. Then October, we dipped back below. And so now here we've come up and we're testing this trend line again. And to me, the issue on these charts is the momentum continues to have a big downward plane to it. And so what we're hoping for, what we're watching for, is some sort of a big magnanimous thrust upward to kind of turn the whole world back into growth mode. And so we've seen multiple central banks try to start the fire. And back in 2012, that's exactly what they did. They all went together, I think it was September 2012, and said, we're going to do something. And the stock market actually pulled back on that news. But it was the best buying point ever, because you had all of the central banks around the world put their wind at the back, and off you went. And so when you see that sort of coordinated approach by the central banks, that would be helpful. Now, we don't have that right now. We have the Japanese bank is buying their ETFs. We have the China bank doing trying to do what they can. We have the Eurozone, which has been in quantitative easing but hasn't increased it or whatever, but it hasn't helped either. So they're still having purchasing managers index, lower readings, that kind of stuff. So the problem I have is the Canadian market. Here was the uptrend on the momentum in 2009 and then in 2016. And now we just briefly dipped, but the real perspective is this big, longer downtrend in momentum. And so for us to be on this right shoulder of this triple top, very close to negative, and you can see that when we go negative on this indicator, these are bigger bear markets, not something to be lightly thought about. And again, we haven't got there, but the problem is we've really barely got bouncing off of zero. So if we were to roll over again right now, it wouldn't take much to send this into a bigger downward spiral. Now, if it was only the Canadian market, that would be one perspective. And perhaps what I should have set up was, let's just go grab a chart here. I've got a chart list of all of these monthly charts, and I just want to find it. Where are we? Here we are. Okay. And with all these monthly charts, the problem we have, so this Brazilian one looks pretty good. It's up nice and high. It's up at around 10%. But if we just flip through here, here's Russia. And you can see they've had a downward slope. They're just barely above zero. They're at 3, which is better than us. We're at 1.5%. And they're at 3, and at least it's pointing up. But again, look at this. So far, the month of May looks a little weak here. And where are they? They're right at a major reversal level. And again, still putting in lower highs since 2008. So really rough going there. But if this was to start to roll into negative territory, obviously that would be a problem. Now, if we go on to Australia, what we see here is the same sort of downward trend. Now, it's tried to break it, and it's up around 2.5%. But again, it's made a lower low, so far a lower high, and it's broken this big uptrend line that goes back 10 years. So I'm starting to get more worried that these are bigger deals starting to show up. And if this rolls over right here, just barely above zero, I think that's a critical place on the charts and not one that'll probably be corrected quickly. So looking at TSX, so again, just to put that number into perspective, we're sitting here, call it 1.5%, and we can at least compare that momentum level against other charts. So here's China. It's still in negative territory and trying to rally. Had a really rough this is still going back to April 30. So this was the monthly candle for the Shanghai Composite. Basically opened up, went all the way up, came back down, and actually made a lower close than the previous month. So that's pretty much a wasted candle and what we would call either a spinning top or a shooting star. And so here's the Hang Seng, and it's pretty much right at resistance, so that's important. It's at around 2.5, maybe 3%, something like that. But clearly a lower low so far, and now the question would be if it rolls over here. So again, it hasn't rolled over. I'm just trying to make the analogy that if all of these things start to fail here, this won't be a small detail. This is a pretty significant place on the charts for everything to fail globally at the same time. And so here's the Kospi, and it's right at zero or just below. So obviously, if it doesn't continue to rally, that's a big deal. And you can see on this chart, this level's been kind of key for a long time. It had a brief rally in 2017 and hasn't done much for almost 10 years. The Nikkei, this is the one that bothers me the most. Again, lower highs, lower lows, and broke the uptrend line going back 10 years. And you can see these uptrend lines. That was a pretty good clue in 2007. But we had a series of rising lows, and even if you draw your line here, we're still below it. But the issue is we're down around 2.5%. And again, we're trying to get back through in this case, I think that's the 10-month moving average in blue here, this big blue line. And if this is a fail and we end up going back below it, I think that's a bigger problem. For some reason, this chart didn't update. Maybe Japan's been on a holiday or something. I'll have to find out why there's no data there. So here's Indonesia, and again, same issue. Look at how low the momentum is in the bottom right-hand corner, and it's been that way for the last 3 or 4 years. So I realize the market can make higher highs, but if everything starts to go negative, that's a concern. So that's what we're watching for, is all of a sudden, as all of these upsloping trend lines start to break and everything rolls negative, that would be a big deal. So on a lot of these charts, we're below that trend line. And here's India, and this is a really important one because they have some of the best demographics in the world. And again, if they can keep this nice big uptrend going, look at how strong that is. And you're above zero on every dip here, very cool. And if it can break out to the upside, extremely bullish. Conversely, if it starts to roll and break this big 20-year of upward momentum, that's a big deal. And it's up around 6, so it's definitely by far one of the more bullish ones. So here's Germany. And Germany's actually sitting right on zero. So hard to get comfortable. It's below its signal line. It's below the big 15-year uptrend line and is now just barely sitting on zero. So to come back, have a rally, and then pause here would be scary, terrible, not good. Again, when things are negative, they fall hard. So you don't really want to see negative momentum on these charts. And look at Germany, it would be basically a left shoulder ahead and a right shoulder on a big multi-year kind of topping structure, and just something to be very aware of. So we're there right now, and the real question is, do we have any more horsepower? So it's the location of all of this momentum having broken uptrend lines and near zero that we really don't want to see. So that's why I'm more worried that the right shoulder might actually have an exacerbated move down as opposed to just a nice gentle pullback. It's the position of this PPO near zero giving us this clue. And again, here's the 2015 trend line breaking. And so it breaks the uptrend, comes down, and stops at zero. So that's good. And so far, it looks like we're stopping at zero. The issue is, again, all of this advanced decline line data, purchasing manager index data, net new high data is not supporting the start of another bull market. And so that's one of the reasons that I'm more concerned that this high will be a relatively sudden one and would catch most people off guard. Okay, so that's, we can go continue to work through the world, but let's just go look at the S&P now. And the point I want to make on the S&P, they're still up around 5%. This is a big bold market, but they have broken the uptrend too. So here, if you end up having some sort of a market topping structure, and I would say it's probably a couple more rallies away or whatever before it might actually roll over. I don't know that. But here we are. Look at the 50 level. Just hold on this RSI. It stays up here in a big bull market, bounces up but can't get back to overbought. This would be kind of concerning. And again, if it goes back below zero or below this 50 level, usually that's kind of where bear markets are on the monthly charts. So looking at this PPO, we've got this kind of downtrend coming in here. And again, we've broken the uptrend and we broke it here and it waved down and now it's come back up, but it's still making lower highs and lower lows. And now the real question is, do we have the momentum to get going here or do we stall? And so far we're stalling at the prior high on the US market. And there's all kinds of bulls out there. I get it. If I'm too pessimistic, the biggest reason I'm pessimistic is because of the where the big momentum is on the monthly charts. And again, all the way back in October, participate in the bear market rallies. Try and ride them as long as you can, but be worried about protecting capital rather than just trying to be all in. So here we are with a PPO line and the NASDAQ trying to test its prior high, and so far it's holding. And again, 2 days doesn't make a trend change. But the bigger issue for me is a lot of the markets are testing these prior highs or important event locations, and the momentum on the weekly charts is starting to run out. So if we go to here's Germany. And this weekly chart, the bars are getting smaller. Everything looks fine on here. Go contrast that with the Canadian market. And what you see here, these prior highs, and we've quickly given it all back. And again, we have one more day tomorrow to see where we're going to finish. But it's this failure at a prior high that's very concerning. And what happened back here? So we test a prior high, we run up, and then we jog sideways after breaking through. But you don't really give it back. By the end of the week, it bounced off a big low and came back up. So maybe that's what we get tomorrow, a huge up day. Canadian market would have to run up a couple hundred points to do that. But again, the advanced decline line data doesn't support that sort of move. And so as you get through these prior highs, you want to make sure you've got the power. So here took 4 weeks and then the market finally gave it up. And then here we pushed up for 1 week. We got up above it. And then we spent the second week going sideways and then the third week working our way down. And then we just ended up making lower lows and lower highs and continuing on to this parade. So here we are. We went up. We spent 1 week up there. We built a doji. And literally it was a doji to like 0.00 gain on the week. And then this week it's been straight down pretty much. So lots of reasons to be worried about breaking this higher high or failing to hold the higher high. And the second component of that is if that's going to fail now, based on that advanced decline line data and the net new high data, typically that's when the market accelerates lower. So it's kind of like these bars or this bar, not really kind of the smooth jogging bar that we have. So that's what makes me a little bit more puck shy. Okay, let's go back and talk a little bit about the energy sector because I just wanted to point out, and again, I think I've mentioned it many times before, but I think of oil much more like an economic indicator. And many people can disagree with me, that's fine. The bigger thing that we want to talk about on here, and I'm just looking for it, it's in here hiding, there we are, energy. So what we see here is there is an uptrend going here, and now we're clearly just literally rolling over. But where are we failing? Right at the 200-day moving average. And if we go back to this big chart here, this is the big picture for Canadian energy from the oil high back in 2014. And rolling down, got down here, rallied up, and came up, and now that was the second point on this trend line. Then we fell down. But every time we have trouble, more and more trouble around this 200-day moving average. And so here we are, we just got to it, and now we collapsed. But we also failed at the trend line and horizontal support and resistance. I think that's a terrible place to fail. And so this chart looks to me like the PPO is going to roll over below zero here. And I think we have much bigger issues. Now, again, I don't know. A whole bunch of central banks could come and get organized and start to do something. But we just heard from the Fed saying they don't see any need to do any of that right now. So I think we're in a big bear market. I think for Canadian energy. And so if you put a line here on the RSI at 60, you'll see we stayed down here for a year and a half. And now we've bounced up and we're still stuck under this 60 level, and that's typical of bear markets. And then go back down. And now when we get down here, we'll see if we make a lower low or if we hold the prior low. But I think if we've got big global economic weakness, this is a bigger issue and we need to be much more defensive and try and get prepared for a bigger issue, and especially if the monthly PPOs start to drop below zero. Okay, let's go down. I want to make sure I cover off the marijuana, and the reason I want to cover it off is because it's been a big growth industry. I published some articles recently saying they're trying to break out again, and then sure enough, what do? Break out and fail all in the same week. So pretty important place on the charts, and again with the Canadian breadth data, just be way more careful than otherwise thinking, oh, okay, it's just a brief breakdown and I don't want to go anywhere. So here you are sitting at 140, call it, on the healthcare index for Canada. And we had one spire, church spire above that level, but for the most part, that's been resistance. And so now here we have this kind of head and shoulders topping structure on the right hand side. The PPO, daily PPO, is at zero, near zero. And if we go back and just look at the weekly version, the issue here is we had a high, a slightly lower high, but now we're rolling over right here, and that's why I put in here, I'm very worried that this group breaks down here, and sure enough, it makes a rally just into the beginning of this week and then falls apart very quickly. And that these right shoulders do that kind of thing. Like look at over here, you're rallying and rallying and rallying and then just down, down, down. They don't really give you a nice exit. They're rough. They're brutal. And so be aware that the PPO momentum rolling over on this index is not to be taken lightly. Okay, so okay, so that's a concern. But let's go into the actual marijuana names, and then you can decide for yourself which way you want to take these. I need to go up here a little bit further, and there we go. Marijuana names. And the point I want to make here is look at this, break out perfectly, and then literally 11:29, we're at 9:50. We've dropped 20% in 3 days here. So this is whatever we dropped, $1.20, $1.10 in 3 days here, which is at least 10%. But we made it all in two as well. So straight spike up and a straight pull back down. So that's a problem. Here's Kronos. This one hasn't really got going, but it looks like it's ready to roll over here. Canopy Growth, this is the one that I really thought was breaking out, and I'm going to go to the daily chart here. So on this weekly, it was breaking out of this big downtrend, so looking very, very bullish. And then here's the daily. And the problem on the daily is, look at this, we're just trying to get up here. We literally go above this one for one day, and then give it right back down. So we've gone from $71 to $65 in 2 days. And it's as we're trying to break through and as the Canadian market's getting weaker. And look at where the momentum is here. We've got lower highs on each one of these peaks. So if this is rolling over right here, really important place to be cautious and take profits. Okay, Aurora Cannabis. Hasn't really got going on this rally at all. Brief spike up on one day and gave it all back and then continued to roll back down. So holding at $12 for a couple of weeks here and then all of a sudden spurred above and pulled right back down through it. Not really caring about Scott's. GW Pharmaceuticals, just holding in the range here, but again, hasn't done anything above this range for a year and a half, so let's not get too excited. E plus, this one was looking better. I kind of expected it to roll over here, making a right shoulder. Has not. I leave that on there just to remind me what I was thinking. But the momentum is trying to hold, and we haven't done anything for 3 or 4 months. It did not participate in the spurt this week. So far, flat on the week. Okay, the HMMJ, so this is the average of all of the stocks. And what you see here is momentum's below zero on a daily chart, which is not worrisome. I mean, that's just part of normal business where you rally below and then rally back up. But the issue here is for such a hot performing group, look at how we're underperforming the S&P 500. And now all of a sudden we try to rally, and what's the first thing we do? We give it right back again and start to underperform. And we're below zero here. So this is an extremely cautious place on the chart. And again, it's the broader picture of the Canadian market being weak in general. And if this was a high flying area and people start to back away from it, they'll back away from it very, very quick if they think the overall market's letting go. So, here was the October move in marijuana. And again, Weed Wednesday is in here, October 17th. The US markets topped, call it the end of September. So it had 2 days spiking right into that. And then what does it do? It literally unloads and falls from 25 to 12, 50% in the same time the indexes fell 20%. So it's a very difficult spot here. And I participated in this rally as well. We're breaking the downtrend. We're starting to turn up. We're starting to turn up in momentum. We get our scooter ranking all the way back up into overbought area, or not overbought, but strong area, and then it turns around and falls back again. That's a big deal to me. And so I really, again, with the Canadian market setting up the way it's set up, I just really want to be cautious here. So I locked in some profits already on these. Here's the organic Dutchman, and what you see here is stuck at its 200-day moving average and rolling over lower highs on relative strength. So if this is now marking its turning point, and again, some of these were down hard today. So this one was down 10% in 2 days from yesterday's high. Momentum is just below zero on the PPO. Lots of reasons to avoid that chart. Pyxis. 23.70 to $18. That's a big move, 20% in a couple of days. Pretty rough, rolling over below zero. All of the things you don't want to see a chart do. So anyway, that one looks like another problem. CanTrust Holdings, this chart's been okay, I think. No, this one was the one that cratered. Literally, look at this completion of this momentum, and today it just literally fell, $10 to $7 this week. So that's a healthy pullback in a week. Afria is another big name. Chart doesn't look good. So Canopy Growth, I covered the Canadian side. Let's go look at the US side. And the only reason is, see how nice and clean this trend line was. And look at the volume here, 10 million shares a day. Briefly runs up, gets up to here, and really a big pullback today. And again, if you're going to roll over now, this is an important area. So these things still might fly, but I would be cautious, especially the ones listed on the Canadian side, that if people start to get defensive, they'll be selling those weed names pretty quickly. Okay, let me just go see. Here's Tilray, and this one was interesting because it was way down in the bottom corner here. 50% or $50 level, and I thought it might actually start to rally, and sure enough, it's been one of the clues that it can't even get going. So this one was $300 here last fall. Just open up the chart. When it IPO'd, it went ballistic, and I think whatever in here, it went up to $300. It's now down to 50. It's been a long ride down. And one of the ones that I was excited about was Organigram. And the reason I was excited about it was that it was going to list on the US side. And here you can see just a brief breakout here, 1037 down to 950 already. So a nice push up, but that was only worth 2 days of news to trade on the US market, whereas Canopy Growth literally soared for a while on that news. So lots of them are trying to list on the US side, but look at this momentum. If it rolls over here, that's kind of the signature you expect. So here's your top. Then you, on the next high, testing the same price level, but a lot lower momentum, and down it goes. So if this is going to fail very close to zero here, this is a critical spot. Now, maybe you give it one more day if you got some profits in it, but, I was buying it in here at support, and it literally rolled over, so I sold it today, just trying to make sure I get some gain out of it. But it's the broader perspective of the Canadian market that bothers me to hang around in these names if this is what's going to happen. So, okay, so we've laid that out. The other area of the market that's always interesting for the Canadian investor is the financials, and they actually have been having a relatively good run into the Fed meeting. And so all of them had nice slopes up, and they haven't really given anything back yet, which is quite interesting to me. And the bond market, I went to look just before I recorded the video here on Thursday, and what you see in the bond market is the prices were down today and yields were rallying. So not really sure how to interpret that. And we had the Fed meeting Wednesday, so let's watch and see how Friday finishes, and then as we head into next week, keep a close eye on the bond market because I think that's one of the areas that we've had the biggest clues from, and maybe that'll say everything's okay and we're going to be fine. Um, and I'm just getting a little too bearish, but I think the energy falling apart. Here's basic materials. Look at this thing rolling over right at this 2-year trend line. Couldn't get much uglier. PPO rolling over at zero. Um, so not a lot, downsloping 200-day moving average. There's not a lot of reasons to think this is good. And then if I go grab the copper chart in here, so here's the long-term copper going back 1981, and you can see, we made our highs in 2011, pulled back down, got right up to this $3 level. Well, in this case, I've marked it at 330, and that was a pretty major support level for the highs, and now it's broken down, and this $3 level has become friction. So if we just change this horizontal line to $3. And what we see here is, again, a failure under here, now trying to get going. Now, this has rolled over really, really hard this week. We're at 278, and 2 weeks ago we were at $3. So this thing is moving fast. But look at the momentum, what it's doing on a monthly chart, rolling over right down here. This is critical, and we'll go look at it now on the weekly basis just to kind of point out, see, look at the move down this week and basically blowing out 3 months of support. So if China's getting better and they're the biggest supplier of industrial or buyer of industrial metals, this is a big deal, and it broke support. This 285 ceiling should be support, held up there for 2 or 3 months, and now gives it all back, goes back below the 10-week moving average or the 50-day, but relative strength has been imploding, and we're rolling over right at zero. This is exactly what happened in mid 2018 when the Canadian market stalled in July and copper was starting to let go. So as a commodity country, Canada would probably follow that, and this doesn't look like something we want to follow anytime soon. But that the Canadian market went down much more gently than copper did. But in general, we've got the same problem building. So all of that to highlight that I think things are extremely risky here. And again, they may all work out great, and all of my right shoulder assumptions and all that kind of thing fail, but I'd much rather be aware of how fragile it is and find out the egg didn't break, or stay fully invested, being not cautious, investing in all the high flying stuff, and have it roll over and drop 20 and 30% in the next couple of weeks and go, gee, I wish I would have been more cautious. So here's lumber. Just to wrap up on this note, and the point I want to make on lumber is this is, below zero rolling over. Now, it gives you some, a hammer candle at the bottom here that you'd like to see thrust higher, and that would be great. I think the bigger issue here is watching and make sure it's going to start to break out of this trend, and that would be a very positive thing, much like kind of back over in here. We haven't got that yet. So it's that kind of critical thing that we need to watch for. But if this is going to go for another wave all the way down here into a big bear market, I think you want to be aware of that and wait to see if that trade sets up. So starting to see, this hammer candle gives you some confidence that maybe there's a buyer showing up at the lows, but it doesn't mean it's going to hold. So with that, hopefully I've laid out the bear case. Unfortunately, again, it's the net new highs and advanced decline line data that is just so weak that it makes me leery. Thanks, everybody. Hope your May's better than I'm planning, but hopefully you'll manage your portfolio tightly. Thanks. Bye-bye.